Good afternoon, everyone. As people trickle into this session, we will begin with the ULI Toronto video, then I'll kick it off shortly.
Inevitable. Some things come whether you want them to or not. Fall and winter, traffic and email. Change is inevitable. Good times are followed by bad times, and bad times feel like they'll go on forever. But not all inevitable things are bad. Renewal is inevitable. And the thing is, renewal never comes by accident. It's what happens when people think, work, and build together. ULI Toronto is where city builders of all kinds meet as equals to shape better urban places. Anyone who's been part of it will tell you, ULI is special, maybe even magical. But it's not magic. It's people working together in a special ULI kind of way. Thinking collaboratively, building responsibly, and dreaming hopefully. When we come together to imagine our city, renewal is inevitable.
Good afternoon once again, everyone, and welcome to today's webinar, Real Estate and Resiliency When Policy Waivers, Insurance and Capital Set the Standard. This, of course, being Earth Day. So happy Earth Day to you all, and thank you for taking the time to join us on this important moment to reflect on our Earth, and especially at the intersection of our industry. As always, we acknowledge that the land that we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many First Nation, Inuit, and Métis people. We also acknowledge, importantly, that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. We acknowledge and honor those who've come here involuntarily, particularly those who are descendants of enslavement. Our regular ULI Toronto audience will know that ULI Toronto has produced an important report answering the call to Action 92, a guide to truth and reconciliation in corporate responsibility and land development, and Canada's first such guide aimed at the real estate and development sector at the intersection of truth and reconciliation. Years in the making, this report is just a milestone in our journey into truth and reconciliation, a journey that we invite you all to join. And a link will be posted in the chat, and you can always find this report on our website. Lastly, we are excited to offer a few final spaces to an Indigenous Cultural Competency Learning module next week, Thursday, April the 30th, all day, 9 and 4:30 at the Native Canadian Centre of Toronto. If you've not experienced or taken in this educational program, which we usually make available each October, I highly recommend this module led by the incomparable Bob Goulet. I consider this essential learning for all of us who work in these lands. And as a special note, ULI Toronto is covering all of the costs. Normally, this is about a $200 registration. But we have a few spaces left, and we are covering those costs. So if you register through the link that will be put into the chat and use the code ULI, this is free to you. And if you have any difficulty or challenges getting registered, let us know and we'll help you out. But we do have about 5 spaces yet to fully subscribe next week's module. Today's event and the impact of ULI's Toronto programming throughout the year would not be possible without the leadership and commitment of our annual sponsors. Their support enables us to convene across sectors, elevate best practices, and foster informed dialogue on the most pressing land use challenges facing our region. This, more than sponsorship, is a partnership rooted in shared purpose. Together, we are able to deliver thoughtful programs, credible research, and meaningful opportunities for engagement across our 2,000-member strong network here in the Greater Toronto Area. So on behalf of ULI Toronto staff and leadership, we want to thank these companies for their continued confidence in our mission. Their partnership underpins everything we do. It's now my pleasure to invite our moderator, Luka Matutinovic, who's the co-founder and principal of Purpose Building, and more importantly to us, a member of our ULI Toronto program committee that is actually producing today's webinar. Just as advance before we hand over to Luca, as our abstract describes, what we really are wanted to explore in today's session is how finance, whether that's in the form of insurance or investment, is really not wavering in the way that perhaps public policy seems to be, and that's at many levels of government. But seems to be a pulling back on the demand for high-level resiliency in real estate, in public policy, but perhaps a different story is being told in finance, and that's really the task that we wanted to have Luca navigate an incredible panel that we've put in front of you, and we hope you enjoy this session. And with that, Luca, over to you.
Thank you, Richard, and thank you everyone for joining us today in celebration of Earth Week. As you've heard, we've assembled a fantastic panel of experts with really diverse backgrounds, which I think is a perfect way to tackle today's complex and interrelated discussion on resilience, risk, access to capital, and insurance. As Richard said, my name is Luka Matutinovic. I'm a co-founder of Purpose Building. We're an employee-owned consultancy that delivers end-to-end sustainability strategy and project implementation for the built environment. We help clients that want to develop, design, and own resilient, low-carbon, healthy, and ultimately financially successful assets. So I'm really excited to be moderating this discussion. I thought the video that Richard played at the beginning kind of really framed the context and what I find one of the issues right now, the volatility, the unpredictability, the realization that perhaps things are at a bit of a low point. And I wanted to really paint a picture that I think that's a moment in time. And it's just one of many moments. And we've got a long arc in our industry. And so before we turn to our panelists, I wanted to just share four signals because I think it's important to discern the overall trajectory and the signals from a lot of the noise that can inundate our day-to-day lives. And those signals that I think really point to a very optimistic trajectory for the value of climate-aligned real estate. So the first one is just a recognition that climate risk and climate change are just a non-negotiable reality. We have catastrophic insured losses that are surging from, something like 400 million in the late noughts to over 8 billion in 2024. So that's just something that all real estate owners, insurers, and the wider ecosystem are dealing with. Secondly, there has been a lot of policy shifting, but again, in terms of the overall trajectory, just as one example, the new federal agency Build Canada Homes, through their investment policy framework, wants to deliver and build homes that are insurable over their lifespan. And they have said that they want to prioritize low carbon, climate resilient materials. They ask all proponents that are applying for funding to follow actions that can safeguard against climate risk, reduce, remediate, and mitigate wherever possible. And even at the provincial level, despite all of recent legislation, all the provinces are committed and required to deliver net zero building codes by 2030. Vancouver's got limits on carbon emissions. Toronto's BEPS program is also looking to do the same thing. So there are these long-term signals that are suggesting where policy is headed over the long term. Third, financial and regulatory signals, I think, are really strong. The global benchmarks for real estate valuation, RICS and IVS, have effectively baked ESG, physical and climate risk into their most recent updates to the standards. We haven't yet adopted those in Canada, but these are global standards that are setting the tone, and ESG considerations, including resilience, are now considered critical determinants of both risk and return. We also have in Canada OFSI Guideline B15, which compels major banks, insurers, and pension funds to manage climate-related financial risk. And so there's a growing view that financial institutions will potentially face both credit mispricing risk and lower capital efficiency without integrating some of these resilience and sustainability considerations. And then lastly, in terms of capital signals, we've got in Canada 13 of the 15 largest institutional investors with a net zero commitment. Recent example with Ontario Teachers setting aside $70 billion in climate transition aligned private investment by 2030, which doubles their current levels. And just a recent podcast on commercial real estate had a Dutch pension fund talking about just the importance of future-proofing assets to that long-term capital view, both in terms of exit yields and valuations. So, with that context in mind, I'd like to first turn to our first two panelists and ask them to introduce themselves. Allison, Michelle, the stage is yours.
Thanks very much, Luca. So welcome everybody and thank you for joining us today. My name is Allison Donato. I am the Senior Vice President of Commercial Insurance Solutions here at Tokyo Marine Canada Limited. We are a Canadian-based licensed commercial property and casualty insurer, and we are part of the larger Tokyo Marine Group Holdings family of companies. We focus on servicing the needs of our brokers and customers here across Canada.
And I am Michelle Schwerup. I am the Innovation Director at BDP Quadrangle. So we're a multidisciplinary firm. We operate out of Toronto, or I operate out of Toronto. We've got 19 offices across the globe.
Thank you both. So the first question really directed at you, Allison, because the story of Tokyo Marine and BDPQ is so fascinating and kind of want to walk the audience through that. So you recently acquired ID&E. Can you walk us through a little bit of the strategic rationale and what that means for the group, and in particular, why Tokyo Marine views resilience as core to your growth?
Sure, thank you. So ID&E, who is, of course, the owner of the local firm BDP Quadrangle, which Michelle just outlined, allows Tokyo Marine to move upstream. So that allows us from paying for damage to actively reducing damage and recurrence. ID&E is Japan's leading engineering and consulting firm in disaster prevention and mitigation, infrastructure resilience, urban and spatial development, energy and decarbonization solutions. This acquisition really gives Tokyo Marine deep in-house technical capabilities that insurers typically lack on our own. Tokyo Marine combines with this insurance data and claims insights. So really those kind of ideas and that data around how are losses actually occurring, certainly with the engineering and infrastructure expertise, which is how to redesign the assets and reduce those losses with our partnership with ID&E. This creates, in our hope, and certainly we've seen some progress in this already, a full resilience value chain. So looking at assessment, how do we identify the physical and operational risks before the loss? Preparedness, how do we design and mitigate and sort of implement those resilience measures? Insurance, of course, which is what I do, providing coverage aligned with reduced risk and ensuring that we do protect the assets of our customers. And recovery and a build back better attitude. So rebuilding assets, more resiliency after we see those events. And certainly in Canada, you mentioned 2024, Luca, and I'll discuss that a little bit later in the panel as well. But the idea of rebuilding certainly has become just as important as that preventative measure. So ID&E transforms insurance ideally from a reactive safety net into a proactive resilience solution.
Okay, thanks for that. So that chemistry between an insurer and a design firm, clearly there's some advantages to both your existing and potential clients, even in the absence of perhaps public policy. Could you maybe just explain a little bit how you see that value creation happening?
Yeah, definitely. So, we very much feel that this chemistry matters because resiliency is a long game, which you alluded to, Luca, in sort of your preamble. Both organizations think in decades and not in quarters. So very much that long-term point of view, playing that long game. Tokyo Marine itself has always believed that insurance exists to support society and economic activity, not just to price the risk after the fact. ID&E approaches engineering in much of the same way. So not just designing structures, but thinking about how cities, infrastructure, and assets perform over decades under stress and changing conditions in this world. So that alignment is critical because the acquisition isn't just about short-term synergies, it's about building new capability inside of our group, a solutions platform that complements insurance over the long term. Practically speaking, it allows Tokyo Marine to integrate risk insight, engineering judgment, and capital discipline into a single resilience-driven approach. And over time, that becomes embedded in how the group underwrites risk, advises clients, and allocates our capital. Asset owners and developers are certainly feeling the real pressure of more frequent weather events, higher repair costs, insurance constraints, market constraints, and then operational interruptions that directly affect their income and the customers of our customers. So the value of combining Tokyo Marine and ID&E would enable insurance loss data, showing how losses actually occur, as I mentioned before, and bringing in that engineering insight, explaining how to redesign these assets and reduce these losses, and how that really comes together to allow our clients and then the clients of our clients make better design and retrofit decisions, reduce loss severity and downtime, and really protect that long-term asset value and insurability along with continuity, which really is the purpose of insurance, and ensuring that our customers can operate with their assets and their businesses in the most continuous and somewhat predictable way possible in the future.
Got it. Okay, I could see the value of that upstream move. Michelle, from your perspective on the other side of this cool partnership, you are experts in designing. How has this move ultimately affected, how your firm approaches design? What kinds of insights are you drawing on, or are you able to now draw on?
I think the big thing for me and my thinking about this and our thinking as a company is that it sets kind of a new North Star for us. It clearly says resilience, long-term planning, that's one of the fundamental goals. So we've been piloting resilience workflows on projects. We've been doing that anyways. We've got a deep sort of sustainability expertise in-house. It's something we've been doing for a long time, but it was a bit like pushing a rock uphill. It was a little bit different. The market was different. The market wasn't thinking about long term so much. It was thinking more in the short term gains. So that was a little bit different. So one of the things that it does is it adds a sort of a deeper purpose to these sustainability initiatives. So we've been piloting resilience workflows on projects, and I suspect what this will do is shift us to normalizing these practices on our projects. So things like prioritizing risk discussions with clients and doing that in the earliest days. There's no reason we can't have a discussion, whether it's in the brief or not, identifying those physical hazards on our sites, and then modeling for future climate, something which is totally accessible to all of us in the design process. Since we're doing modeling anyways, why not also design for or be modeling for future climate to understand what the long-term implications are? So this piece around also being part of this larger, we're 200 locally and then 1,000, and then there's a 6,000, but like there's this much larger brain trust, which is fascinating to me. And all of us work across different disciplines, and this kind of work really takes that interdisciplinary approach to design. And now we have access to that knowledge or to that brain trust. And I love that. It allows us to work also in different sectors that are approaching this differently. It allows us to also work at a larger scales. So you think about resilience at the scale of a building, but then you think about it at the scale of a community or a city, and that's even deeper. And so ID&E works at those scales. So it allows us to kind of, we talked about upstream, but even for us, it brings us upstream to be having conversations with cities, to be looking at TODs and master planning, and all of those pieces where each of these groups will have their own objectives, but we're following our North Star where resilience and sustainability is central to that. And then finally, I think this is captured in the fact that we've always done some form of reporting, sustainability reporting that developed into ESG reporting. We did that with BDP and then with ID&E. And now this year we'll be doing it for the first time under Tokyo Marine. And so that just brings kind of a deeper governance and credibility to our work, continues to deepen our culture of transparency and make us more accountable. And the more accountable we are, the more credibility we gain. So all of those things kind of work together.
I love that idea of transparency, building accountability and credibility. That's a really cool story. Shifting a little bit to maybe a broader or a wider lens of just insurance in general. Allison, when you look at those historic losses and the accumulation and just where that trajectory is, what do you think has changed most in how you and perhaps how the insurance industry is, thinking about and underwriting property risk?
Yeah, which is a great question, Luca. So, certainly over the last 5 to 10 years, we're absolutely seeing an increase in weather-related catastrophic loss, both across the personal lines portfolios of the Canadian insurance industry as well as the commercial lines. The weather doesn't tend to distinguish between a home or a commercial building, so really that aggregated loss is quite significant. You mentioned 2024, upwards of almost 9 billion in insured losses in totals. Well, interestingly, 2025 was a relatively benign weather-related catastrophic year. And, I think that's part of the shift in terms of underwriting property risk is, that's sort of the thing with weather. It can really shift year to year. And although we have, tools and predictive modeling and really wonderful things out there where we can look to try and predict and assess that weather related risk, there are parts of the weather that are somewhat unpredictable. And certainly we've seen that pattern with wildfires, for example, or sort of overland flood and not traditional sort of pluvial flood as well. So that shift year to year, does make it a little bit more challenging in terms of underwriting that property risk. And of course, we underwrite property risk to all perils. So that is operational perils and weather related perils. So single risk exposure and aggregation risk exposure across insurers' portfolio exists on a more significant basis now that we are seeing an increase in frequency of weather related events, but also an increase in damageability. And that is partly due to population spread and growth and urban spread, et cetera, in terms of people are living and creating businesses in areas where perhaps 20 years ago that was not necessarily the case across our large country, right? So the management of both single risk exposures and aggregated risk exposures is incredibly important, and certainly on every property underwriter's desk every day when they are assessing a risk. It very much benefits the insurer and our clients in really understanding that risk, not only as we apply policy terms to any given risk as we are underwriting that, but also with insurers supporting our clients moving forward in terms of their efforts to build resiliency into plans at time of construction, for example, or continually innovate and improve on an existing risk, and certainly understanding what that weather pattern might look like and in conjunction with their operational single risk exposure. Recognizing that clients are starting to take risk mitigation efforts, both on operational and weather related risk, very seriously. It very much can support the unlocking of greater capacity, greater interest in the market in that risk and ensuring that risk. But I think most importantly, longer term success and more sustainable and predictable terms and conditions, as I mentioned earlier, for our clients and then the clients of our clients, right? We deal with losses. That's part of the reason insurance exists. We are there in our clients' toughest days to support the rebuilding of that asset, for example, but really shifting into that resiliency and preventative loss is really going to build in that continuity in a somewhat unpredictable weather-related kind of environment going forward in the future.
Okay. So maybe to make that a little, just going a little layer deeper or more tangible for folks that own, develop, and manage assets, for both of you, if we look forward to 3-5 years out from now, what do you expect would be considered table stakes evidence of a resilient asset, or what would be evidence of resilience for either an asset or a portfolio, something that folks that might be listening can take away?
Sure, Michelle. I'll start, and then you can jump in as well. But so I mean, interestingly, the question is sort of 3 years from now. But I think the time for everyone, insurers, clients, brokers, individuals, is to focus on resiliency now to prepare for the future. And preparing for that future is really critical for the long-term success of everybody in sort of the insurance client, relationship. At times, and I think you alluded to this, Luca, right? There could be stalled policy actions. We do need to come together to support one another in our resiliency actions today. So for our customers, really thinking about that risk mitigation, not only from that operational perils perspective and how your building performs in its core function, but also with respect to resiliency to this ever-changing weather environment is absolutely critical. Being mindful of implementing climate risk mitigation at the time of construction, for example, whether that be through preventative measures such as water detection systems, green certifications, upfront sustainable building materials as you are constructing those buildings is going to become increasingly important. It certainly already is today, but I think certainly in the future, that really is how we are going to support one another. Once that building is operational, as we are underwriting those, taking continued steps to increase resilience through innovation, certification, ongoing improvement efforts is really vital. And that's not only a part to play for our clients and our customers, but really for folks like me as well in the insurance industry. We have a part to play in this to ensure that long-term success. And that part really is focusing our efforts, not only, as I mentioned in sort of the beginning of my part here, not only on sort of paying for the asset that was damaged post-loss, but contributing as insurers to our clients' efforts in supporting through education, risk management consultation, influencing policy or regulatory reform, or really just bringing that awareness to the broader group, because it is everybody's responsibility in the world right now. So insurers are not sort of outside of that responsibility. The other big part is really playing our part to ensure the transition, if you will, right? So really looking at supporting customers through capital and capacity allocation on their journey of resiliency. So that means looking at ensuring customers who are at the start of that journey, well, they are looking to transition in the middle of that journey, and then supporting those customers at the end of the journey is really critical. So I would say 3 years from now, it's not necessarily about the insurance industry picking those projects, those assets, those customers that are fully at the end of that journey. It is to be there to support the customers, because as I said, resiliency and the management of climate mitigation is everybody's responsibility.
Thanks, Alison. Michelle, anything to add from a design perspective?
I think from a design perspective, like how we're going to know that it's working, I think there's two parts to it. So in my mind, so there's the once it's done and it's functional and we have a climate event. To me, it's how quickly does that property, does that city recover from what happens? So it really is about rate of recovery, because you want to have as little downtime as possible. You want to have in a residential building the ability to shelter in place. You want to make sure that those that are vulnerable in society have the ability to stay where they need to be, that they know their neighbors well enough. And part of knowing your neighbors well enough is quality design. It's about building places, placemaking, so that people are able to connect one another. As Alison said, the insurance companies might not be there. The regulatory people will not be there. The people that are going to be there are the people that live next door to you. And so part of building good places is having a community where people know one another, reinforce one another, and have plans for what to do. And that comes from creating incredible spaces. So to me, there's that piece of it. And then there's sort of the hard side of it. So making sure that we put the right infrastructure on backup power. And I'm not just talking about backup power so that we can exit a building like we're, to have traditionally thought about backup power. It's in case of fire, because fire was the big emergency. Well, now it's different. Now we're talking about 72 hours of backup power until the cities can get back online and functioning, so that a building can operate autonomously for a period of time, have the ability to be there. And so part of that comes with putting things in place that promote passive survivability. So thicker walls, well-insulated walls, good windows, that if the power goes out, and usually that happens on the coldest and the hottest days, how do you maintain internal temperature? Well, if you have a really warm blanket or a really good wall, that keeps you warm when it's cold and cool when it's hot. So that's a really big piece of that is being able to maintain indoor thermal comfort. Working with durable materials so that there is less damage. So something will happen, and none of this stuff is a guarantee. What it is it's a way of thinking about it, planning for it, and creating the best possible outcome. All of these things are based on predictions and based on what we have experienced in the past. And I think the third thing that I would add to that is a culture of literacy around this. So what we're doing today is wonderful because we're hearing from people from all different disciplines. And what we're doing is we're growing literacy around what is resilience and what's the importance of it. And we're realizing that there is true value in doing this because if you have a community or a city or a building that prospers, then you also attract investment. And then you have a good economic situation, the community continues to thrive. If people no longer believe that this place has credibility or this building or this community, people leave. And when people leave, so does the investment. So to me, that's a really big piece of it.
Okay. Thank you both. That's a perfect segue to bring in a few more of those experts and make the conversation more well-rounded. So you've heard now from an insurance perspective, you've heard from a design perspective. I think it's a good time now to hear from both the capital and the real estate owner and investment perspectives. And so I'd like to call on Sam, Jacob, and Kit to introduce yourselves in no particular order or that particular order, and we'll pivot a little bit to capital and real estate considerations, and then we're hopefully going to have a bit of time to bring everybody back together because I think there's going to be a lot of points to kind of connect together. So maybe start with you, Sam.
Yeah, thank you, Luca, and thanks everyone for being here. So my name's Sam Barbieri. I'm with a company called Taylor Co. We're asset and property managers on a portfolio that's just over $2 billion. I've been working in the space for over 25 years. In the last 10, I've had a very deep focus on sustainability. In my previous job, I was on the team that was operating a 2 billion plus core plus fund that's submitted to GRESB on an annual basis. We started at a 4-star, worked up to a 5-star, and in 25, we were number one in our category out of 212 other funds in North America. So we were very focused on sustainability issues, and it's sort of been a passion of mine over the last decade.
Thanks, Sam. Jacob, over to you.
Yeah, hi everyone. My name is Jakob Bilgaard Hansen. I'm representing IFO, the Export and Investment Fund of Denmark. I will be speaking into a Nordic European perspective, but we are also active in the Canadian market. We provide risk-tolerant debt, both senior debt and mezzanine debt, by providing credit enhancements to banks and capital to additional capital to the debt market. So my angle will be from a more European, Nordic perspective, and I'll be speaking into that. Thank you.
Thanks. And Kit, last but certainly not least.
Hi, everyone. I'm Kit Milnes. I'm the VP of Sustainability and Resilience at Kingset Capital. For anyone who doesn't know, Kingset is a private equity commercial real estate investment firm. We are Canadian focused, but we have a wide range of investors from institutional pension funds to ultra high net worth individuals. So I think family offices. So we really see a gambit from the investor side of, what the different appetites on sustainability, climate risk are. And so we try to tailor our products to meet the maximum and bring the minimum minimum focuses along to highlight the value of kind of why we have to do these things, why depending on the investment cycle, 2 to 5 years or open-ended long-term hold, never sell these assets, why the tailoring changes and how you can best adapt to those. We have about 18 billion in assets under management. We have developments, existing assets, and we do a lot of commercial lending. So we bound kind of what we learn on the asset side to our lending side and try to bring our borrowers along as well. We understand, not every borrower, not every developer has a in-house sustainability team, and everyone's coming from a different point of learning. So a big focus of ours is kind of what have we been able to practice and learn and scale on our, long-term hold assets, and then how can we share that with the market to bring everyone up and move forward and learn together.
Thank you, gentlemen. I like that little bit. It sounded very similar to Michelle's idea of growing literacy, and it sounds like that's what you're doing with your diverse investment pool. So that's great. Sam, perhaps I'll start with you. I mentioned that, I feel like we're in a moment in time and there is this optimistic trajectory. I mean, it's why I wake up in the morning and we do what we do. But maybe to start with you, where do you think we are in that cycle of resilience and sustainability in terms of its importance to real estate investment and particularly ability to attract capital? What are you hearing from investors?
I think during the initial phases of COVID back in 2021, sort of the discussion was on hold for a period of time. I think we've come out of that, and I'm optimistically thinking that the point of inflection has taken place. I've talked to a number of stakeholders over the last number of months, and they are focused on sustainability in their portfolios. In the last number of years, there's been three focuses that I have talked to stakeholders and investors about. Climate risk, whether it's physical or transition, has been sort of paramount. Net zero carbon with the pledges that are being made for a 50% reduction from a 2019 benchmark by 2030 and 100% by 2050 is definitely a focal point. And I think there's action plans now that are not just being drafted, but they're being implemented. 2030 in the context of carbon is tomorrow, and people are acting on these plans. And then the third thing is asset level performance as measured across a portfolio using the GRESB survey. So those would be the 3 points of focus that for me were very relevant in conversations over the last few years and are even more relevant today. I was having a conversation with an investor last week. And again, they brought up sustainability. They brought up those 3 themes, and it was very much a focal point for them. So I think if you're talking to investors, you're thinking about portfolio construction, you're thinking about your pledges against carbon, you're going to be focused on those 3 themes essentially. And asset level performance, I think, is critical across the board. So whether or not it plays into your carbon planning and your net zero carbon pledges, or whether it plays into your climate risk planning, your portfolio construction, I think everyone is really focused on how do you make these assets as efficient as they possibly can be.
Okay, that's great. Maybe as a quick follow-up, are these conversations showing up in investment committee conversations? Are you seeing a different kinds of questions emerging? Is there more scrutiny being applied to a commitment and a desire to actually see implementation or evidence of asset level performance or shifts in that performance? Can you speak a little bit about that?
Yeah, I think there's a few things playing out. One is carbon risk and the value attached to it. And it definitely is showing up in investment committee discussions. In my previous life, there was a whole section on an investment committee memo that related to sustainability and those 3 key themes. When you're talking to investors as well, I mean, the question is, how does it impact valuations? There's a number of different organizations that have spent a lot of time working through different models and organizations that are in the industry who have their own proprietary models in place, trying to sort of track what is the valuation of carbon going forward? How does it impact my asset? What happens if an asset in, theory is stranded at some point in time? What does that do to the valuation? I know that there's organizations like MSCI in their indexes that are trying to now track the valuation related to things like carbon risk and net zero carbon and climate risk. And, it gets better over time. But, if you go back a few years, these were sort of vague concepts in terms of how you translate that into value. And I think it's getting crisper and crisper, and it's definitely more the focal point in the discussion going forward.
So maybe one last one for you before we turn to the other two guys. In terms of what Canadian owners and managers can do to better position their portfolios, to construct better portfolios, to better attract perhaps a more diverse range of capital sources in what I think is an increasingly competitive landscape. Any practical suggestions to offer?
I think starting with net zero carbon, first of all, I mean, at this point, I would suspect that all the major investors and owners have plans in place aligned with their pledges for a 50% reduction for the most part by 2030 and 100% by 2050. And now implementation, has likely started across the board. And for those that haven't, it will start soon, with the first target being 2030 and then followed up with the second target in 2050. When it comes to climate risk, I mean, we were using a tool in my previous life. They're not perfect tools when you talk about hardening assets. Many of these tools don't take that into account. They're sort of geographic positioning tools. They will take various weather patterns and geographies into account, but any work that was done on hardening an asset is not taken into account. But investors and owners are thinking carefully about how they construct their portfolios to deal with climate events in certain parts of the country. And they're sort of thinking, okay, if there's flooding in this area, we're probably not going to be investing in those areas and we'll focus in other areas. So definitely factors into the portfolio construction piece. And it's being thought through very carefully when assembling a portfolio across the country.
Okay, thanks to that. Kit, maybe I'll turn over to you now, just maybe to build on that idea of risk assessments and hardening assets. How are you looking at that at KingSett? What kinds of filters are you applying? Are the questions changing, or what are you seeing?
We try to be proactive on this. I know some other companies have kind of implemented similar things where in the due diligence phase of a new acquisition, we have certain screenings that go into the due diligence checklist that we have to run through. So we understand the upfront acute and chronic risks very quickly. And then if any one of those passes over a certain threshold of scoring, that will trigger a more fulsome assessment if we're really considering the acquisition. So those are CVAR assessments, climate value at risk. And that gives us a kind of a 5 to 15 year look at what type of capital we'd have to invest in that asset if we purchased it in order to mitigate those risks, and what kind of potential losses we'd be facing if we didn't do that. So that that's on the acquisition side. I'm not sure kind of like where we're at with how much of this is actionable. Would we buy that asset and then spend that capital in day one? Probably not. But it's helping us learn, and it's helping us put this additional kind of lens over how we build the risk profile of a potential purchase. And we're taking that same methodology and applying it to our existing portfolio as well. Now, timing does matter. Are we going to spend money and do this for a 2 year hold or a 5 year hold? Maybe on just a screening analysis, but getting a full assessment done and then starting to plan capital around it, probably not. The timing on kind of when you're going to spend significant capital really matters, and everything kind of has to line up the right way, but it comes back to building the knowledge base. We've moved in the last 5 years in sustainability from, just talking about energy efficiency to talking about all of ESG to now talking about risk mitigation. And so it's really on the risk piece that I think you can find a lot more kind of buy-in from the investor side, but it's still in the early days of figuring out how you layer it into everything else and then figuring out what's actionable and what's not and on what timeline.
Okay. I've heard that idea of risk becoming sort of the more important, or maybe not the most important, but certainly a more important lens. And I'm wondering if, when resilience risk or physical or transition risk does show up, and you're sort of got maybe a marginal decision of whether to acquire or not. Does it tip it into a no? Have you seen, that happen and that kind of play out where um, whether you have a fully, baked in CVARs, or whether there's some risk and there's something that needs to be done to manage it. Is that actually starting to change, certain decisions that get made?
I'm not sure if it's starting to change decisions yet. I think we're still in the phase of building up the knowledge
Mm.
and understanding, even though a risk might be high, is that a risk that is high to say don't buy the asset or just be aware. I look at it as like the PRI kind of approach. The principles for responsible investing don't say don't do a certain investment. It just says understand the entire risk profile and be comfortable with it if you're going to do that investment. So every organization is going to have a different risk appetite. But I think we're at the early stages of kind of building out what the physical climate risk appetite is and how far companies are going to want to lean into it or not. And the ownership cycle really matters on this, similar to decarbonization. You're not going to decarbonize an asset if you're going to be selling it in the next year or two, because the market has a really hard time on figuring out what that value premium is for it, especially if those systems aren't up for renewal anyway. And so you're just going to be like all of that capital is going to be non-planned for. And you're going to have to kind of take write downs off of your amortization because things aren't recovered. Physical climate risk really falls in that same bucket, unless it's the really low-hanging fruit, similar to like, energy efficiency lighting retrofits. You could put flood sensors, you could have some updated controls on your BAS systems. But if your risk report comes back and says you've got a mechanical room that is below grade in the basement and it's at a high risk of flooding because you're in a high flood zone or something like that, retrofitting that on its own has a risk mitigated perspective, but it doesn't have a payback perspective. So it's really hard to get investors bought into that. You would then be looking at, okay, well, how old is all that equipment in there? And how can I time eliminating the environmental risk of this with the capital renewal cycle and replacing the equipment on its traditional timeline?
Okay. And perhaps to flip that around, as that market sophistication grows, as valuation starts to increasingly consider this, presumably on the buyer side in that due diligence process, now that becomes something that they're aware of, that they think about when assessing whether to buy that. So, I think how
Hmm.
you frame that, I think, having that but it sounds like a lot is more capacity building, more understanding of all parties. So speaking of a broader perspective, Jakob, I'd like to sort of bring you in right now. The EU and the Nordics in particular are often looked at as leaders in this space. So wanted to just get your perspectives on how these discussions are playing out, in particular in resilience and when you're
Sure.
yeah.
I love because we are entering into the discussion after Alison and Michelle have identified the projects, after the real estate companies are to meet their pledges and targets, and then we are meeting the investment manager, then we are meeting the treasury function, and it always starts with the same old view on getting a capex investment to work. It is always starting with a value add type of discussion. And with many of these resilience projects, with many of these sustainability projects, it actually doesn't add up. Then we're turning to the banks. All the banks in Europe has carved out a huge part of the balance sheet for these type of to support these type of transformations of real estate assets, but they're still remaining the same look on loan to cost, cash flow, covenant level, and the tenor of the debt that they're ready to provide. So what we have seen in the European and Nordic market is that actually our own normal origination process didn't work. we should approach the real estate companies with a different angle, and that is more the risk of ended up with stranded assets, risk of erosion of value, because then we actually get some tension, and then you can see the needle moving in the discussion. It is perhaps a bit easier if you are a new investor into an asset. But if you want to transform an entire portfolio with 500 real estate assets, then it's tricky because you have promised the investors a certain cash flow, and if you are to do these investments, that will eat up a bit of that cash flow. So that is actually what we have seen in the European and Nordic market, that from a pure profit-oriented approach, we cannot get the projects to move fast enough. Then it will be a bit here and there. But if you want to transform another entire portfolio, then you need a new angle, and you also need some new tools to actually do that. And that is where we play a role from IFO side.
Okay. And in terms of some specific examples that a European investor might be looking at as important features of an individual asset or a portfolio strategy, are there things that you're looking for, signals that you're looking for, that you mentioned the idea of downside risk or brown stranded assets? Are there things that signal to you that there is proactive management of those risks on the building or the asset side?
Sure. We actually have one of the largest real estate developers in the Nordic area. They have just created a fund with a resilience target, meaning that they have looked into globally all the cities that has a low risk of flooding, low risk of environmental effects, and that is the target. They need to. It comes with a balance, because then they're not able to invest entirely according to profit models, but that is the immediate profit models at least. But that is the view that these assets will be selected out of resiliency targets rather than pure profit targets. Of course, they need to provide some profit to the investors, but that is the trade-off that they're trying to create with this new fund for investors that would like to also have a bit invested in pure resilience in that aspect.
That's really cool. I've heard of net zero alignment, but this is, I think, the first example that I've heard of having actually a resilience target within an actual fund. So that's really good to hear. Maybe one last one for you. What do you think is needed from a debt provider's perspective to support these kinds of investments in resilience and maybe sustainability more broadly?
Sure. We always work together with commercial banks that understands the local markets and local standards. What we need is the financial authorities to ease up their view on these investment, helping the banks to push a bit more. We can provide a credit enhancement. We can take balance sheet risk away from the banks. But they also need to be able to provide very long tenor loans themselves. You can see in the Canadian market, then we still see some shorter tenor loans. And that doesn't fit with a long-term resilience investment. That doesn't fit with a long-term sustainable investment. You need, from an investor point of view, at least from a European investor point of view, to lock in the risk so that you can be able to actually get the gain and repayment from the investment and match it with your financing solution. Then, so I actually think if you're able to qualify as either high dark green sustainability or super important resilience, then you should need to have better terms when the financial authorities are looking at the banks. And we'll do our utmost to also help mitigate the risk for the banks. But you need a bit of help, because otherwise, it will be investment for investment. You need to unlock the capacity from all the commercial banks to actually fuel it. That's at least one statement from our side.
That's a good perspective. And I know that Canada is a little bit behind in creating a taxonomy that would better define what a resilient or sustainable investment looks like. That work has been done in other countries. So it does sound like there is more needed across a number of different stakeholders. And certainly the valuation piece sounds like it's going to be an important thing. I do think that there is growing appetite and growing desire to do that and to direct that capital into some of these projects. So that's really great. I'd like to bring Allison and Michelle back into this and just kind of circle back, sort of looking, the conversations that Sam and Kit and Jakob had provided, the points about how capital is starting to increasingly look at this, the kinds of trade-offs that might need to happen, the kinds of granularity and perhaps asset or fund specific things that Kit brought up. Any perspectives on that? Any sort of nuance? How do you tackle that tension between trying to, create a long-term strategy and a direction, but sort of respond to these very unique, either client situations or unique asset situations? It feels like there's a lot of moving pieces there.
Like I can speak to it from a design perspective. I think part of it is understanding the goal of the client from a design perspective. What are you trying to achieve? How long are you going to keep this asset? What does it mean to you? Because there's sort of two parts to it. There's the cost, the capital cost of doing something and doing things to designing things to be resilient often means building out some redundancy in your systems, which, as they've described, is hard to capitalize. I guess part of what needs to be looked at with that is the cost of inaction. So should something go wrong and you have to build it back, what is the cost of that? So including that in the valuation, I think is an important piece. And so I think this is where I think we also need to be building capacity on the design side, not even just from the technical side, but from a costing perspective. So when you're costing these projects, when you're valuing them, that needs to start to become a normal part of the costing process. And then the other piece I would add to this is, Sam talked about the fact that most people are starting to decarbonize. That's just a part of what real estate, what we're doing in real estate. In my mind, doing your resilience check at the same time makes absolute sense. Those things happening in parallel because you can start to think about passive survivability in conjunction with that and starting to think about, yes, you're moving to electrification, but you should also thinking about what kind of envelope solutions, because maybe your envelope is coming due for renewal. So thinking about those in tandem.
Okay, thanks for that.
Yeah, and I sort of was just reflecting a little bit on Jakob's point around, the offset in the additional risk or costs that these clients might be taking as they're on their resiliency journey, right? There does need to be a bit of give and take in the insurance industry with that as well. So, we price risks based on potential and expected exposure. And if that exposure improves due to resiliency measures, long-term measures of improvement in terms of that risk exposure profile, there needs to be some benefit back to the client in terms of that, whether that be, policy terms and conditions, pricing conditions, all of that consideration. And I think that is something that the insurance industry across Canada is doing better than previously, but certainly more work to be done on that. And our role as insurers as well, is supporting our clients in the long-term journey. So that idea of bridging the gap between potential data and insights we may have as the insurer and getting that into the hands of our customers through our brokers in a quicker, more collaborative fashion is really going to help, right, as we move forward. And I think that is the biggest opportunity for the insurance industry, is outlining what is that reward, so to say, in terms of improving your risk, but also ensuring that the insights that we can gain as insurance companies are translated back to customers in a really usable way as they're making asset decisions.
Cool. Sam, Kit, any concluding remarks? I always like to give folks in the audience, some tangible stuff that they can do tomorrow, conversations that they can start having. How do we build momentum following what I thought was a really great and robust discussion on a lot of these topics?
Yeah,
We'll probably
so
need
for
about
me, I think
a
the
sentence. Sorry,
I'll
Sam. We'll
be
talk
real
about a
quick here. For me,
quick sentence. Sorry.
the conversation has, the point of inflection, that conversation has happened. People are again focused on sustainability, and I think looking across their portfolio to implement plans is in play and will continue.
To Michelle's earlier point of like, early is better. This isn't like decarb where, you could wait a couple of years, prices come down, technologies change. The risks are going one way and they might change with the weather every year, but they're on a trajectory upward. So don't feel afraid to get a study done 5 years or 6 years before you're actually ready to take action. And then yeah, I'll leave it at that.
Love that. Thank you so much. Richard, over to you.
Well, I thank you, Luca, and thank you, Kit, Sam, Allison, Michelle, and Jacob. We always end on time, and we're right at 1 o'clock. So I'm going to really just say thank you to all and happy Earth Day, a sobering a discussion. It was so important that we had this discussion, though, because I think in this moment there are some economic realities related to, as Kit said, the fact that the risk is only going one direction, whether we like that or not. And it was really important to have this conversation. So thank you all. And we hope to see others in the audience at a future ULI event. There are many always on the horizon. All the best. Bye-bye.
Thank you all. Take care.
Bye.